What's up everybody and welcome back. Today I want to make a quick video to discuss a crucial topic for anyone looking to purchase real estate as an investment income stream. The impact on interest rates on real estate investments. Understanding this relationship can help you make an informed decision and maximize your investment returns. First, let's clarify what an interest rate is. In simple terms, interest rate is the cost of borrowing money. When you take out a mortgage to purchase a property, the interest rate is what the bank charges you as leverage on the money that you are borrowing. Interest rates can fluctuate based on several economic factors at that given time. Depending on where interest rates are, this most certainly will affect your buying power. When rates are lower, your monthly payments are lower. That means you can afford more house. When rates are higher, your monthly payments are higher, which means you can afford less house. For a real estate investor, this is particularly important because if you are in the market where rates are lower, while rates are lower, prices of the homes are probably going to be higher. Versus when rates are higher, it's better that you're able to get a deal that the cash flow a little bit more. All of these things are important because this affects your monthly cash flow. If you get a property where in a market where rates are higher and you don't get a property at a highly discounted rate, then your monthly mortgage payment may not make sense based on the average rental comps. So these are things that you want to check out before pulling the trigger and purchasing that property. To sum that up, what I'm basically saying is the market has ebbs and flows. When we see rates are lower, that means that we're probably going to have a lot more demand in the market from investors and just regular home buyers as well, because people can afford more at that given time. When rates are higher, less people are able to afford what they desire or even able to afford homes at all, whether you are an investor or a home buyer. So there's not a lot of demand in the market when rates are higher. These are things that you definitely want to take into consideration. Also add this, buying a property when rates are higher is never a bad idea. In fact, it's my favorite time to actually purchase properties or to help my investor clients to be in a position to get more aggressive when rates are higher. Because one thing that we always know is, for the most part, not all the time, but for the most part, we can count on real estate doing well here in Dallas. What we can also count on is that some people will always need somewhere to stay. For a perfect example, if you purchase an investment property when rates are higher, you always have the opportunity to refinance that debt when rates go down. Now, when you refinance that debt, there's two things that can take place at this time. Your monthly cash flow will increase, especially if rental rates are increasing. Your monthly mortgage payment is gonna go down, either stays the same or increases, which is going to invest your monthly cash flow. Or you can take another strategy, right, as far as monthly cash flow, and just refinance that property and pull some equity out, which could possibly, like I say, decrease your monthly cash flow, but it gives you the leverage to go and purchase another property and rent that out and rinse and repeat and do the same thing. So to wrap this up, high interest rates is not always a bad thing, especially for investors. My personal opinion, I absolutely help my clients, my investor clients, strategize to get really aggressive in a market where rates are higher. Simply because, like right now here in the Dallas-Fort Worth area, there's a lot of inventory on the market. So my clients can get aggressive with their offerings that they're offering to these homeowners, which helps us to get these properties at a lower cost. We can always refinance later on down the line to get a lower payment, but it's a win-win for my clients because we're getting the properties cheaper than what we would when rates were higher. And then we also have enough equity. We're buying them deep enough to where they have enough equity to be able to refinance to get a lower payment in the future. They want to refinance to take cash out to purchase another property, they have that option as well. So if this video was helpful to you, give me a thumbs up. If you have any questions or would like our investment strategy on how we're helping our clients to take advantage of this market that we're in, give me a call at 469-530-0934. Thank you.